Wang. Welcome to this virtual workshop on the accounting design project. I'm Chu Liang, and I'm going to moderate today's session. Today, we are very pleased to have Sean Wang from Southern Methodist University to present the paper, Acquisition Prices and the Measurement of Intangible Capital, co-authored with Michael Evans from Caltech and NBER, and Ryan Peters from Tulane University. Just a few housekeeping items before we start. First, I'd like to remind you to stay on mute unless you're asking a question or making a comment. If you could also turn on your camera so that we could have a more like a face-to-face seminar and might have a more active participation. If you would like to ask a question, you could either use the raise hand function that you can find from your participation list on your Zoom, or you can just type the word question in the chat box, and I'll call on people in order. And if you don't want to ask a question, but just would like to share a comment with us, feel free to also use the chat box, and at the end of the session, all the chat will be made available to the speaker. And Sean will have the first 5 minutes uninterrupted, and after that, he'll be taking questions. And towards the end, he will also have 5 minutes uninterrupted to conclude. With that, I'll turn it over to Sean. Thank you.
Thanks for inviting me. I'm excited to present this paper. Definitely special thanks for the people who organized the event, and for all of you guys for coming to take the time out of your day. So again, this paper is co-authored with Mike Ewens, who's in the econ department at Caltech, and Ryan Peters, who I met when I was giving a talk at Tulane, who is actually in the finance department. So again, I've got a few free minutes here. So what I'd like to do is to start out briefly with the motivation of why we think the topic is important, and then move to the problem that we attempt to address, and then briefly discuss what we find. So, to make a long story short, the economic landscape has changed pretty significantly, even from the days when I was a kid. For example, in 1980, when I look at the top firms by market cap, names that come up are things like Exxon, Schlumberger, AT&T, IBM, and fast forward 40 years, and you look at the top firms by market cap, and those names are things like Apple, Amazon, Facebook, Google, and so forth. And so the economic landscapes has shifted. And these graphs, I feel like, tell a lot of the story of the shifting landscape. So we can see here, for instance, that CapEx intensity, as measured by CapEx scaled by assets, has decreased markedly over the last 40 years, while we've seen exactly the opposite trend here from R&D intensity. This is, in our opinion, a very large and significant impact. And net tangible assets, for example, as a percentage of market cap, on this graph here on the right shows this for the S&P 500, has actually dropped from 83% in 1975 to 10% as of 2020. And so, I think the Bill Gates quote sums it up a little bit about how much things have changed. When he was trying to pitch investors and bankers 40 years ago, they had so much difficulty in really understanding how software could generate returns in the long run. So, long story short, the economic drivers have shifted specifically from a very physical world to an intangible type of economy. But that being said, accounting standards have not necessarily evolved in sync with these changes. And perhaps this is good reason, owing to things like verifiability of assets and conservatism. And the point of this paper is not to get into a debate on that at all, but rather to understand the increasing impact that intangibles and this off-balance sheet capital has to potential users. The basic idea is that the impact of expensing intangibles is that a large amount of the firm's capital, its internally developed intangible capital, remains off the balance sheet. And thereby users are forced to recreate the capital stocks in order to perform any analyses that rely on the book value of assets or the book value of equity. And so because this bias, as I alluded to, has gotten so much bigger over time, any error in the inferences from not capitalizing these off-balance sheet intangibles has potentially gotten larger over time. So that's where we come in. The goal of our work is to attempt to accurately estimate parameters that'll allow us to recreate a firm's intangible capital stocks. And we do this by developing a model that allows us to estimate these parameters along with a set of market prices. So again, recapitalizing intangible capital isn't a new discovery. We've known this for quite some time. So this is just a very quick, brief overview of where the academic literature stands currently with regard to this measurement issue. So intangible capital, or internally generated intangible capital, is taken as the sum of knowledge capital and organizational capital. Within the literature, knowledge capital stock is the consensus that this is the sum of unamortized R&D flows, or specifically, last year's knowledge capital stock multiplied by 1 minus the depreciation rate. So this is the unamortized stock at the end of the year, plus any investment flows related to knowledge capital. And this is proxied for by the amount of R&D in the given year. And similarly, for organizational capital, this is essentially the sum of unamortized SG&A flows over prior years that represent investment. Again, within these two equations here, delta is depreciation and gamma is the percentage of R&D or SG&A that represents an asset or a long-lived investment. So here's the status quo where things currently stand. The latest estimates, for example, for R&D depreciation come from Lee and Hall. And they essentially estimate the depreciation of R&D investments based on the rate at which profits are decaying for the firm that makes the investment. They rely on BEA, NSF, industry level profit data, and come up with delta Gs that vary between 12 and 38%. This is generally what's being used currently in the econ and finance literature. But again, their coverage as far as delta G currently has a fair amount of gaps. So their data set only covers less than 11% of SIC codes, 28% of CompuStat firms. So when this delta G number is missing, they tend to revert to the older Hall estimate of 15%, which came in 1990. Gamma, which is the fraction of R&D that is to be capitalized, is assumed to be 1. Okay, that's just the way that we've done things. Organizational capital, the work there is even more sparse. Currently, the gamma estimate is 0.3, but this comes from a single study using the aggregate data of 6 pharmaceutical firms, and delta S is assumed to be 0.2. And that's just the status quo numbers that are being used to recreate this organizational capital. And there currently is no industry variation in these parameters. So what do we do specifically? We develop a model where we essentially use prices as the left-hand side variable. And we obtain these intangible prices from 2 sources. One is publicly traded equity prices, and the second is public firm prices. We estimate a set of parameters that allow us to recreate intangible stocks for a full set of CompuStat firms. And then we take these full set of new intangible stocks for intellectual capital, organizational capital, and run a series of validation tests to determine which stocks best represent what we would expect to see in the real world. And overall, we find that it seems that our exit-based price parameters seem to work best. And so we get some industry variation as well, some differences from the status quo. And of course, our data is available for download. So again, that being said, I'd like to see if there are any questions that have built up already thus far.
Sean, I just have one point. Estimating these amortization rates is pretty tricky.
Sure.
The papers you looked at as a point of departure use firms where I think the R&D has been successful. Most R&D is impaired. If you capitalize, it's impaired. Okay, so the impairments are not in that data at all. So I think this is a real problem in terms of assessing amortization rates. And when you think about it, if you've got a firm doing R&D, it's a biotech startup. It hasn't got any product yet. There's no revenues. There's no customers. What's the amortization rate? Okay, it's a hugely uncertain enterprise. Okay, yeah. So trying to get hold of it, I think, is a very, very difficult issue. So I'm very keen to see what you're going to do here. Okay, the fact that you might distinguish by industries is interesting, because all those aggregate numbers are just for firms on average, and that's no good for accountants, because we've got to distinguish by individual firms. We've got to distinguish R&D, which is likely to be successful, from that won't be successful, it'll be impaired. And any amortization rate validated must have the impairments, also if you capitalize. You see, I'm really concerned of the great difficulty here behind the whole enterprise. Mm-hmm. If in fact you're doing R&D and the chance of it paying off is only 5%, well, you got 95% probability you're going to have an impairment. And pretending you can amortize that seems to be a little bit far-fetched to me.
I mean, I agree with you that, and again, this is probably something that we should probably do a little bit more research on the actual variation in the outcomes, right?
Yes.
The data that we gather essentially are industry averages across them. So I think the point that you're trying to make, Steve, is definitely a valid one, which is the firm specific. The idiosyncratic level of success within a firm could be potentially very large relative to the industry average, which could result in certainly errors in inference, right? I think we acknowledge this and probably didn't have a way currently of specifically assessing a specific firm's level of R&D aside from the exact exit sample that we currently have, because of course, there aren't current market prices that are seen on R&D. So I agree to some extent. What we have are industry level aggregated values, which we still think are very helpful overall and do seem to describe industries or the aggregate as a whole, and seem to do a better job than what's currently existing. But I think in some sense this does suffer from some of the similar problems that the other prior work has already
okay
done.
Yeah, I think the idea, but I'll leave it at that. Maybe I'll come back to you later, but let's see what you're doing here.
Sure.
I think that the key issue here is struggling with these amortization rates. Okay, and if you've got something to put on the table here, this is going to be very, very helpful. But if in fact you're 95, but you don't know anything about the R&D and the payoff, whether the drug's going to sell or not, you've got a very high probability of an impairment in the future. Your current accounting says, let's just impair it now. and let's not pretend we have an asset on the balance sheet and you can use for collateral, and that you can amortize in a sensible way. I think that's a way to see the point of departure from the current accounting. The current accounting says, no, I can't put on the balance sheet because I just got no idea. Mm-hmm.
Yeah, I mean, I think the current accounting does do that, but then at the same time, when you look at what people do in industry when they look at valuations, when they're trying to actually craft, compare, for example, ROE to WACC, or compare, book to market, you need to make some sort of estimate to account for the intangible capital, and to call. So, it's one thing to say, well, it's noisy, but it's one thing to say perhaps that, well, it's noisy, let's put 0 down instead. That makes, in my opinion, a lot of sense if you're sort of catering accounting statements to debt holders, for example. But then that still leaves the guys on the equity side with having to put something else in there to make the number more meaningful. And so that's kind of where we were going with this idea.
Yeah, I won't hold you up, but there's a point that there's not just a balance sheet, there's an income statement, and there's a basic accounting rule that if the benefits from the R&D are coming through the income statement, okay, it doesn't matter if it's on the balance sheet or not, okay. If they're not coming through the income statement, then you have a heck of a problem in terms of understanding what's going to be the payoffs, the uncertainties there. So I think that's the tension here. There's to see that the accounting problem is solved by putting something on the balance sheet is not quite correct, because there's always an income statement. So Coca-Cola doesn't have its brand on the balance sheet, but it's quite easy to value actually, because the earnings from the brand are coming through the income statement. A mature pharmaceutical is much easier to value because you get earnings from R&D coming through the income statement, versus a young biotech which doesn't have any products or customers as yet, where it's going to be very difficult to establish these amortization rates.
Hi, Sean. We have another question from Professor Bosun. What about Peters and Taylor intangible adjusted Q ratio? Professor Bosun, would you like to elaborate your question?
So Peters and Taylor JFE 2017 have a sort of shortcut adjustment to the Q ratio, which normally has just tangible assets. They incorporate R&D and 30% of SG&A other than R&D, and show that this sort of predicts a future investment or future financing much better than the traditional Q. And so it seems there are other ways of trying to incorporate intangible investment into valuations.
Yeah. So again, the Peters and Taylor paper was sort of where this paper was sprouted from, in some sense, a derivative of this paper. So Ryan Peters, of course, is one of the co-authors of this paper as well as that one. And the Peters and Taylor numbers are actually the status quo numbers. So those numbers are actually, using, Lee and Hall 2016 and 1990 for R&D, and then they're using these delta S of 30% and gamma S of 30% and delta S of 20%, right? So that is currently the latest state of the art. That does improve certainly significantly over just a traditional Q ratio in terms of describing investment. And so when I presented this paper with Ryan, we started talking about that paper. He said that he felt that there was certainly room to improve on that, because a lot of the current measurements were noisy. And again, going back to Steve's point, perhaps they still are noisy with respect to any specific firm, but we feel that the validation tests do a good job of showing that on average the measurement design that we've set up appears to do a little bit better than what the latest technology is.
Thank you. We have another question from Ayun.
Sham, I have a question about your table 1. So I don't know whether you want to kind of like talk about your methodology when you present your parameters estimates in table 1, then I ask my questions.
Sure,
Yeah,
that's fine. Yeah. So, okay, then, I think table 1 that Ayung was referring to refers to the parameter estimates and how and what pops out of essentially the structural estimation that we do. But I'd like to just, quickly run through the parameters of how we arrive at the estimation, and then I think I'll come back to your question. Is that okay, Ayung? So again, as I alluded to previously, the goal is to measure this internally generated intangible capital stock, where you have these two measures of capital, the knowledge capital and the organizational capital. These things are essentially going to be based on the prior investments of R&D and SG&A. So what we do is we set this variable P, which is the market price for all of the firm's intangibles, okay? So we set P is equal to this variable CASI multiplied by the sum of externally acquired intangibles and internally generated intangibles. Now, we know that externally acquired intangibles are actually showing up on the balance sheet in the form of identifiable intangible assets and goodwill. And then K is ultimately the value that we're trying to solve for, which is the sum of G plus S, which are based on these two equations up here. We take the log of both sides, which leaves us with the log of CASI plus the log of the sum of total intangible capital. And then this CASI essentially is essentially the intangible market to book ratio within this structural equation here.
So I don't quite understand. These are the prices of these components, right? They're not the cost you expend on it. So that you're thinking about fair valuing the intangibles right on the balance sheet, are you?
These are the fair values, because essentially the data that we look at are either market traded prices or prices that are coming from an acquisition where they are ultimately revealed to the balance sheet at market values.
Okay, but when we think about capitalizing R&D, we think about capitalizing the cost, right, onto the balance sheet, not actually marking that to market.
Correct. So that's why we have this variable here, CASI, which is ultimately the market to book ratio. So everything on the right-hand side is book, and then we have this market to book multiplier, and then what we're able to capture in the data is ultimately market price.
Yeah, I'm sorry, I missed that one. That's good.
Okay.
Yep.
So now we take the log of both sides, and then we take the variables for G and S, and we expand these equations here. So you ultimately have 1 minus depreciation rate times R&D, and similarly with SG&A, and then ultimately we run the estimation to solve for delta G and gamma S. You can't actually solve for all four parameters at the same time. So we follow prior literature and assume that gamma G, which is the percent of R&D that is being capitalized, is 1. And then we assume that the depreciation on SG&A is 0.2. Now, because ultimately the only thing that you can optimize is some ratio of gamma to delta, and in later sensitivity analyses we do try to tweak these things to see how they change, and it turns out that the stocks don't actually change that much, because if you move 1 gamma, then a delta moves, and so forth. So this is the basic idea. This variable is available on CompuStat as our R&D and SG&A. So then, where we're trying to, what's driving the difference in our two estimations are where we infer these values of prices from.
Oh, hi, Sean. May I interrupt? We have a question from Professor Oliver Binks.
Sure.
Yeah, thank you. Hey, Sean, just one question here about the SG&A capitalization. I mean, when I think about SG&A, I think also a lot about, just typical overhead costs, right? So like a lot of stuff that is not necessarily paid for obtaining like some future benefit. It's also like a lot of running costs, right? And I assume that that's why you have that parameter right before it, right? So
yeah.
Then my question is: so do you let that vary by firm, or do you implicitly assume that this is always like the same fraction for every firm?
Oh, okay. So yeah, I should be clearer about this. So the variables that we end up solving for within this particular estimation are going to be this gamma S and the delta G, and these are run by industry across Fama French 5 industries. And so the gamma is what you were alluding to, the fraction of SG&A that truly represents long-lived investment, i.e. we're the part that's not the overhead cost. So so this is what we're actually solving for, and we now allow this to vary by industry.
Thank you.
Hi, Sean. We have another question from Professor Zihang Peng.
Right.
Hi, Sean. I'm just thinking, so if I understand correctly, you infer the kind of the intangible market book ratio based on acquisition prices. So perhaps that one issue with that is that firms that gets acquired may have like different types of innovations, right? Or they are at different stages of innovation of creating this internal intangible assets, right? So I recall that one of the recent review of finance papers by Hoberg and Phillips, they talk about how more successful innovations tend to get acquired by other firms, where it is more efficient to leave the more uncertain innovation unacquired. Perhaps the internally generated intangible assets are fundamentally different for firms that get acquired and firms that are not.
Yeah, I mean, it's a great question, and certainly something that we've given a lot of thought to. Again, I think the point that Zihang is trying to make is that is it possible that firms that are being acquired have fundamentally different levels of success with regard to their perhaps their R&D investments than firms that don't get acquired, right? And so that's certainly one of the potential pitfalls of using the exit sample, which is why we ran these two samples in tandem against each other. So again, we use two samples of market prices. We infer them from two different places. So one is publicly traded equity. This is going to be a representative sample that is essentially inferred from publicly traded equity and doesn't have necessarily the same selection issues that we potentially are seeing with the exit sample. So if you can actually give me a second, I'll detail the differences between the two, and then I'll come back and see if there's still anything that you'd like to follow up. Is that okay?
Yeah, sure. Thank you.
Sure. So as I was alluding to earlier, and what Zihang said is that there is this potential problem that the investments in the acquisition sample may not necessarily be representative, and so we wanted to just. The idea was let's do the best. It's hard to find market prices, first of all. So let's do our best to try to come up with market prices of intangibles, and then let's see how the data looks when we test this, and see which seems to fit our intuition better. So let me detail for the two different types. The first is publicly traded equity. And again, this is just essentially based on the full CompuStat universe. So in this case, we just have standard total assets equal liabilities plus equity. And then in the middle here, we're decomposing total assets into physical assets and intangible assets. So we solve for the market value of intangible assets, which is this PIIT, by just subtracting the market value of tangible assets to the right-hand side here. So now we can ultimately calculate this, right, if we have all these other pieces. And of course, the market value of equity for publicly traded firms is very easy to find even on a daily basis. So then we need to make assumptions for these other three variables, right? And so the assumptions are generally that liabilities and preferred are trading at par, which is done in a lot of other papers and generally assumed to be a reasonable assumption. But then the one that was tripping us up the most with regards to this particular estimation of PIIT is that, you know, this variable here, which are the market price of tangible assets. We know, of course, from accounting that tangible assets are recorded at historical cost and then marked down because of depreciation. So because these are not marked to market, we need to ultimately attempt to guess what the market price of these tangible assets are. And any error that comes about in imputing PIIT is going to ultimately affect the ability to infer accurate estimates in delta and gamma.
Oh, hi, Sean. We have a question from Professor Penman.
Oh, sorry to interrupt again, Sean. The way we typically see businesses work is for assets being combined together to generate value. So Coca-Cola has a brand, but it also has a lot of red trucks and bottlers, okay? Tangible assets. Mature drug companies have brands, they have the R&D operation. So the value comes from actually joining them together. In other words, in business, there's no standalone value for individual assets, okay? Here you're assuming that actually the value of assets, individual value, you can sum up to get the value of the total. But in business, the total is more, the total value is more than the sum of the individual assets. See, they're all used jointly. And you're assuming that there's standalone values for all these assets.
Yeah, I mean, we're attempting to isolate standalone values for intangible assets, because I guess the way that we approached this was to look at the value from intangible assets, that the value that can be directly generated from intangible assets.
I think that's the point. The value cannot be alone. Tangible assets, your R&D takes on value because you're Merck and you have a great distribution system through to the doctors, and you have factories and processing to produce the drugs. It all works together. So to pretend that there's a standalone value is sort of not how businesses work.
Yeah, I mean, the way that I've understood how, you know, things are ultimately marked to market is that you know, PP&E and things of that nature will reflect ultimately what are the currently available traded prices for similar assets. So my thought is, for example, you know, if Roger Federer holds a tennis racket, that is worth a lot of money because he can win Wimbledon titles with it. If I hold a tennis racket, it's whatever I can buy it from the sporting goods store with. So if an auditor came and tried to mark to market this tennis racket, like the way I would see it, if Roger Federer was holder it, Wilson racket $200, knowledge, whatever intangible capital he has ends up taking the rest of that value. That's ultimately how we've modeled it in this equation. So anyways, but again, going back to this point, the big issue is trying to come up with an effective way to mark up ultimately the firm's physical assets, because we don't observe them directly. So there are pluses and minuses to this publicly traded equity story. The plus is, of course, that we're able to observe and take a representative cluster of firms so that there isn't necessarily a selection issue that's going on there. We do try various different types of markups, and we ended up following what prior literature does. They just assume that the market value of, this is Erickson and Whitehead and Peters and Taylor, they assume that the market value of tangible assets is ultimately equivalent to the gross PP&E, which in my opinion isn't probably the best in terms of intuition or logic. We do try various different things where we estimate the age of the assets and then mark up the assets by whatever we assume the rate of inflation to be for a particular firm or industry in some robustness tests. And so so again, ultimately, our paper comes out and says, look, we run all this stuff with two different models. It looks like our exit sample comes out with more effective parameters. But, I don't necessarily want to come out and say, look, this sample is always better than this sample. The parameter estimates that are revealed are ultimately a function of how well you can deduce the price of intangibles, and so there are potential problems in both of them. And we do the best that we can in trying to address this. And ultimately, the validation tests show that our measure appears to be better than what's currently being used. And so for that, we're proud of that. But it's not necessarily to say that this is a perfect measure by any means. It's just an improvement upon what's currently existing. It's, in my opinion, a pretty significant improvement. So this is, again, the publicly traded sample. The next sample is the exit sample. And in the exit sample, we look at firms that are ultimately exiting public markets. So we look at firms that are being acquired. And so in firms that are being acquired, we're calculating P of IT, which is equal to IIA plus goodwill. So IIA are supposed to be the identifiable intangible assets. These are things that could, in theory, be identified and separately sold off that have standalone values to a third party. And then goodwill essentially represents these unidentifiable intangible assets. Okay, so that's the idea behind that. So within all of our acquisition data, we hand collect these purchase price allocations and take the sum of IIA plus goodwill. Now, we're fully aware that goodwill catches many other things, perhaps such as synergy and overpayment. So we make an adjustment to goodwill following, Bogat et al. 2005 to attempt to isolate the true unidentifiable intangible assets, and then sum those two values together to get the price of acquisition. So, long story short, the prices for these exits come from acquisitions, but then also, and again, this partially I think may address Zihang's point, is that previously he was saying that that firms that are being acquired may have R&D or SG&A investments that are potentially different from or better than others. So we use actually all firm exits. So in addition to just using acquisitions, we also end up using liquidations as well. And in liquidations, we have to back out and try to estimate the intangibles from the proportion of assets that are recovered in the actual liquidation. So the exit sample actually comprises exits from being acquired as well as exits that are owing to bankruptcy or liquidation. So again, to make a long story short, we compare the estimates from these two different samples, publicly traded equity, where the challenge comes from, in our opinion, trying to estimate the markup to these tangible assets. And then we look at the exit prices, which in some sense we feel has the advantage of this due diligence process, that is going to give us a nice measure of IIA, and then we make adjustments to goodwill to try to isolate or remove out those components that are related to synergy and overpayment. So we sum IIA and goodwill together, and that ultimately comprises the left-hand side variable in the exit sample. We then run this estimation, and we solve to minimize the sum of the squares in delta G and gamma S. So here's what we find, and so here is what we use. We're using 10 years of data. This is R&D and SG&A data from Compustat, and so we've got the 3 different samples here. This BEAHH is the status quo. This is the current existing, what's being used in the literature today. And you can see, for instance, on average, it's 0.3 is the proportion of SG&A that should be capitalized, and they find on average a 0.28 for the R&D depreciation rate. When we look at the data for prices, the 2 different data sets that we have, you can see that there is some variation that's pretty significant across the 2 samples. Basically, the the gamma S and the delta G are going to result in significantly higher stocks in this publicly traded sample, which may actually imply that we don't mark to market enough the market value of tangible assets. And then in the exit sample, we actually end up seeing smaller overall stocks. The R squared represents how well these coefficients are able to fit the data. The R squared looks significantly better in the exit sample than the trading sample. So when we looked at this, we thought, okay, it could be potentially the case that the exit sample is just going to do better when we subject it to all these various tests. But again, this is within sample. So when we do the series of validation tests that we end up looking at, we actually strip out all the firms that are being used in the estimation. So the validation tests are essentially as out of sample as we can get them.
Oh, hi, Sean. We have a question from Professor Binks.
Sure.
Yeah, hey, Sean, just another question here. So when you look at your estimates there, I mean, it seems like they vary a lot across your 2 different samples, which I guess kind of indicates a little bit like these things are basically the conversation that you had with Stephen earlier. These things are pretty hard to estimate. And then when you look at these original estimates, so basically just these very constant estimates, like they often seem to be kind of somewhere in the middle. So would one interpretation be that they actually guessed pretty well already before, and this is more kind of a better estimation that kind of justifies a bit what they have done before?
Yeah, I mean, we're not going out to look that paper actually. So the work that's done previously, over several decades in econ has generally been very good, but the methods that they've used has usually not involved market prices. So this was a different approach at trying to try to get to where they got, and so their data was using profit data, or some of them were looking at patent data or patent values specifically. So actually our delta G's are somewhat similar to theirs, is I think the point that you were making in the exit sample, and so we take that as potentially a sign that the exit sample isn't completely out of whack when we first ran the structural estimations, but then we were like, well, let's just put them together to see how they end up doing against each other.
We have the question from Yong, please.
So Sean, when I look at this table, that's column 6, the delta G generally are higher than column 4, the delta G, right? That means that, for example, for column 6, usually those R&D's useful life is like 2 to 3 years compared to column 4 probably 3 to 5 years, right?
Yeah.
And then previously, I know that you mentioned that usually researchers do not pay attention to the numbers, just plug into the regressions for those estimates. But I wonder that whether your edit sample, like what Steve and also Zihan was talking about, is actually conditional on they are being acquired. So can you actually model the probability of a firm or R&D firm being acquired to actually adjust your column 6? Because your column 6 is conditional on some R&D potentially have reached some significant milestone, so they are able to successfully find a buyer and close the deal, right? Compared to column 4 can be the first year of the R&D project. That's what Steve just talked about, that the likelihood to be successful is very low. And that's consistent with your estimate in terms of delta G between these two columns. So it sounds that to make it even more accurate or realistic, I think you can take a look at when you won 2018, JFE has a kind of a structural model about the probability of kind of like finding a buyer in a matching process, and just use his framework to model the likelihood. The way you adjust to the goodwill, you can also adjust to your delta G from the M&A sample.
Okay,
and
that's a great, I mean, yeah, I think you're getting at potentially a way to try to mitigate some of the selection that people are talking about, right? Something similar to Heckman or some other way of getting to the potential probability that this thing is going to be acquired. What was the name of that paper again?
I can say you that paper is that is my colleague from the finance department, and I think he has a whole framework to actually model the likelihood of finding a buyer versus target, so that matching process. And then his paper is about modeling expected synergy, so it's very different from your goal, but I think you can borrow that framework to actually tell people your current column 6 is the conditional delta G, conditional on that firm being acquired, but like to convert that to an unconditional delta G, those are the numbers we provide by industry. And that would be very helpful depending on what researchers want to use your numbers for their specific questions.
Yeah, I mean, we're definitely, like, we're not necessarily wedded to one sample doing better than another sample, or we sort of just, we tried to make a model that makes sense. We try to do the best job that we can to isolate the price of intangible assets. And then we throw everything in there and say, hey, this is what we have. And we're certainly open to admitting that, you know, neither of the samples are perfect, but this is why this is a hard problem. At the same time, we acknowledge that it's a very important problem, and to try as best as you can to do as best as you can is obviously a big deal, right? So so we
welcome. I told you before, like I feel like as a following researcher, I'm going to go to your table A, column 6, and then capitalize R&D that way. So like if you can tell me that it's a conditional and then convert it to an unconditional form, I would be more comfortable applying that number to all the quiz computes that firm. In my regression. Yeah.
Great. Thanks.
Hi, John. We have several questions lining up here. We have a question from Professor Penman, and then a question from Professor Zarwin, and then a question from Professor Roland, and then a question from Professor Zach King. So due to the time, so you can directly ask, I would say, to save some time. Yeah.
I'll be very quick and concede my time to the others. Now, here's something I struggle with SG&A. We pretend there's certain parts of SG&A which are intangible assets we capitalize, and parts that aren't. But in SG&A, most of the assets are jointly made with expenses for current revenue. So advertising, is that generating current revenues, and so we should say that's a period expense, or is it for generating future revenues? Human capital, we're paying bonuses. Is that for current revenues, or is that for retention? Separating these things out, I try to do it, I can't do it. The pretense here that the market can do it. Okay, so one way you might want to look at it is, how do analysts do it? Is there a way you actually can get this separation? We have sort of the Thomas joint allocation problem sitting in front of us here. And in your regressions, remember that the price, your coefficients are going to be determined by the correlations with the residual. And it could be well be that the SG&A is correlated with revenues, for example, okay? That it's not the independent contribution to the price, because it's there's omitted variables here which are correlated with the disturbance which are affecting your coefficients. I find that a difficult question, a difficult issue. Okay, I think the standard setters probably face that. I can identify R&D expenditures separately, but man, I cannot sort out what part of advertising is an asset and which is not. I think we pretend that this is just a disclosure problem. They're not giving us enough information about which are assets and which are not assets, but they can't because it's the joint allocation problem.
I'm afraid I think these are great points. I do have responses, but I think I should probably take them offline because I'm running out of time. And actually, yeah. Some of the most interesting part about this are the results, and I need to at least show you a few results before I run out of time. So I can take a couple more questions. I forgot who was there.
Sean, I'll maybe catch you offline. I'll defer my question because I want to see your results.
Great.
And Professor Ronan, please. Yeah.
Yes, I don't know to what extent this is practical, but I wonder, as part of validation, can you validate the prices of intangibles that you infer by looking at ex-post earnings compared with firms that do not have intangibles or less intangibles? In other words, can you compare your valuations to a stream of ex-post performance of those firms in principle as compared with firms that or control group that do not have intangibles?
Yeah, I think the closest thing to that is probably Baruch and Teddy's 96 paper, where they're essentially looking at trailing values of R&D and how they correlate with future revenues, and they essentially calculate the decline in the coefficients of those lagged R&Ds as the depreciation on R&D and how they relate to sales.
No, I'm sorry. I understand. I think my point is different. It's not estimating the R&D by looking at the ex-post stream, but validating your own measurement by looking at the ex-post stream.
Oh, I see. That seems like something we could potentially do, for sure. Yeah.
Zach, please.
Okay, I think this is going to be quick, so I'll just try to get this in. I think so. In a bankruptcy setting, it's been recognized in some literature that intangibles tend to have lost their value. And I'm just thinking back to Professor Penman's example. If Coca-Cola were bankrupt, their brand is probably not worth a lot at that time. And so I was just wondering, for this column 6, do you have a sense of how those coefficients are going to change if you remove the bankruptcies? I'm just wondering if the reason why the depreciation rates are so much faster is in part because of this bankruptcy sample.
Yes. So to answer quickly, we do in other cases try to remove the bankruptcy sample and rerun the estimation. And not surprisingly, as you alluded to, Zach, the average size of the stocks goes up by something like 20% or so. But I think that goes back to the problem that Steve had, is that, well, you know, if you're or maybe it was Zihang, that if you're only catching the really successful ones, then your parameters aren't going to be maybe as representative as they should be. And so when we actually run the validation test with the parameters that use only acquisitions but not the bankruptcies, the results aren't nearly as good in terms of the validations, and that's probably to be expected. So anyways, that's yeah.
Interesting.
Hopefully that answered. So let me just, so we have a lot of results, and I have like 6 minutes, okay? But a lot of these results have come from presenting this paper in different places and having people say, well, can you show it in this setting or show it in this setting? So I'd like to just show there, we have some set of results that are essentially adjustments to intangible capital as a whole and how it affects the balance sheet in general. And then we have adjustments that are specific to things like, well, do organizational capital outcomes correlate better once you estimate this this stock of SG&As and so forth. I'm not going to be able to get to both of them, but very quickly, let's just look at a few pictures that relate to some of the bigger measures that we have talked about in accounting and finance. So
oh, sorry, Sean. You are accidentally muted. Yeah, could you unmute? Yeah,
I guess I muted myself by mistake. So here's the first test that is worth looking at. So we're looking at ultimately market enterprise value on book enterprise value. And the basic idea in this test is that the correlation, or the R squared, between book enterprise and market enterprise should be better if you account for intangible assets. So the basic idea in this case is that we look at the increase in explanatory power over the status quo. So this is essentially like an increase in the R squared, or in this case, we've calculated as a decrease in the residual. And bottom line, what we're showing in this case is that this line here is relative to the status quo, which is this BEAHH that's currently being used. So in this particular test, we find that in all 28 of our years, or however many this is, more than 28, but we find that the exit sample outperforms what the current metric is. And in this particular case, the trading sample seems to perform worse. This is statistically significant across the majority of the sample in terms of the having an improvement in the R squared of this equation, which is essentially market on book. So that's the first one. When you actually make the adjustment, and this is probably something that we could see that illustrates the effect of the adjustment. Here's the unadjusted market to book ratio. And you can see obviously that it is increasing over time, which is consistent with more intangible intensity. And once we adjust it using the exit stocks, of course, we're adding something to book value here. This compresses down where the slope is much, much smaller and actually centers right around 1. And whether or not market to book should be 1 or not, something around 1 probably makes sense, maybe a little bit higher because of conservatism. But we liked the way that this tended to show up. Certainly it seems to make a lot more sense eye test wise than looking at a market to book of 2.5 on average for the full sample. So that was the market to book. The second one that we looked at is ROE versus RE, RE being the cost of equity. In competitive markets, the basic idea is that the long run ROEs should roughly approach the cost of equity. And so the blue line here represents the unadjusted ROEs, and the ROEs here in the brown line represent the ones that are adjusted for intangible book equity. And you can see that the average annual ROE drops from 16.8% in our sample to a little over 10%. So we said, well, what should it be? And we looked at a few different estimates of how things should look based on the equity risk premium plus the risk-free rate. We used some survey data from Graham 2018. And we also looked at Damodaran's paper where he uses implied equity risk premiums. And those guys come up with, what makes sense is around 10.5%. So we liked, again, the fact that this was able to bring down this average annual ROE down to something that looks pretty close to this here. I've got 1 more minute left. So the last one actually was with regards to the Hml pricing factor. So the Hml pricing factors, of course, value minus growth produces returns. And this is again buried in the back of our paper, but we thought it was pretty interesting because what we were able to show is that currently, if you don't adjust the HML asset pricing factor, there are about 20% of the firms that are currently being missorted. So in other words, they show up in the low book to market sample when they maybe should either be in the medium or the high, or vice versa. And what we actually show is that, for the returns that are missorted, the HML loading factor doesn't work at all. In fact, it goes in the wrong way. When you actually recapitalize HML, it makes the return spreads much stronger because now we're correctly accounting for the adjustments to book equity. And there have been prior papers that have said in finance that have said, is the value effect actually decreasing over time? Does HML not work nearly as well as it should? And we think that maybe this isn't necessarily the case, but rather there needs to be an effect for intangibles. So that needs to be accounted for. So long story short, we developed this model that allows us to estimate intangible prices, capital, and we ultimately estimate parameters and test these parameters. We find that the exit-based stocks appear to outperform the status quo and the publicly traded equity. Again, our data is being updated whenever we make changes to the paper and can be currently found on Mike Ewan's GitHub site. And that's all I have. So thank you very much. Next week is Alfred Wagenhofer on rules versus principle-based accounting standards. Thank you.
Thanks, Sean, very much.
Thank you, Sean, for the great presentation and the audience for great comments. So we have the next workshop in 2 weeks by Professor Wagenhofer. And thank you again, everyone, and I wish to see you in the next workshop. Yeah, bye. And if you have further questions, feel free to exchange your ideas with Sean offline or stay later a little bit beyond today's workshop. Okay, thank you.
Thank you.